Good morning, everyone. I am Stuart MacDonald, Chairman of Aaro Capital, the pioneering funds of funds manager established over 5 years ago to offer institutional quality investment solutions in the crypto or digital asset space. As we all know, an exciting new asset class, not always fully understood because it is still new to many people, has emerged around distributed ledger technology in and around the blockchain and crypto assets. And this is certainly a good time to be looking at it. Aaro's thesis has been, continues to be, that the most effective way to capture the tremendous investment opportunities in this fast evolving space is specifically through professionally managed funds of funds. The performance of our different investment strategies, each with its particular exposures and reward profiles, has demonstrated the success of this approach. So has our emphasis on managing risk as well as reward. Now, I wish you all a very warm welcome to this, the latest in Aaro's long-running series of educational webinars. You can look at our website and see an impressive set of white papers and thought leadership pieces that you can use to inform yourselves beyond just today's session. But more immediately, one of our founders, Chief Investment Officer, Ankush Jain, who received the accolade of being a Forbes 30 under 30 for his achievement in helping to build our company. Ankush will take you through the landscape and the opportunities. Now, can I ask participants to please use the chat function to put forward your questions? If there is time, Ankush will address them. If not, then please get in touch with your Aaro contact and we will come back to you. Ankush, over to you.
Okay, great. Thank you, Stuart. And good morning, everyone. So my name is Ankush, the Chief Investment Officer and Co-founder of Aaro Capital. Very happy to be here today. And we'll be covering the investment opportunities available within crypto assets and distributed ledger technology. But before we do that, some background on Aaro Capital. We established this business in 2018 as one of the first genuinely institutional quality fund of fund specialists in the crypto and DLT space. We have a team of around 20, mostly based in London, with 8 on the investment side, which is the largest team of its type in this space. And our aim generally is to capture the long-term opportunities generated by distributed ledgers over the long term, whilst also capitalizing on the short-term opportunities presented by crypto assets in what is still a very young and inefficient market. And we aim to do this in a professional way, in a diversified manner, and through risk management via fund-to-fund strategies. So we have a range of products. You can see on the right-hand side here, just outlined some of them. In May 2020, we launched the diversified fund-to-fund strategy, and that has exposure to a wide range of liquid investment opportunities. Last year, we launched a market-neutral crypto strategy, which has been a nice complement to our existing flagship product. And we're currently in the process of launching a directional crypto fund-to-fund strategy. Last year, based on our research and our database of over 1,000 crypto funds, we also released the Aaro crypto fund indices. We like to call them the ACFI, a set of crypto fund performance indices which are available on our website, and tracking performance by strategy grouped according to our own classifications. Now, moving on to the opportunity, what are crypto assets and DLT? Well, you can consider crypto to be the economic innovation, and DLT, or distributed ledgers, to be the technological innovation. So on the right-hand side, distributed ledger technology is commonly known as blockchain. It's a different type of database. It's a type of database with no centralized store of data, no centralized control of a third party, and therefore very transparent in the way it works and secure in terms of record keeping, and has many key advantages that can be applied to different sectors and industries. And McKinsey actually outlined a paper where they went over 90 different use cases of this technology across 14 different industries, and that ranges from finance to healthcare and even art. So the opportunity set is very vast, and the estimates of the value to be generated by distributed ledgers in the next 10 years are estimated to be in the trillions. So it's quite a compelling long-term investment opportunity in its own right on the centralized side. On the left, we have crypto assets. So crypto assets use DLT in some form, but essentially they're a form of investable instrument, and they act as an incentive mechanism for people to maintain blockchains, decentralized blockchains, and to use blockchains in particular ways. So they can come in the form of tokens, they can come in the form of cryptocurrencies, and it is still a pretty new, quite a new market, so very inefficient, very high returns, but also a lot of volatility, and therefore a great area of focus for active fund managers. So both sides of the argument are quite interesting. You have crypto assets, short-term volatility, a very long-term picture in terms of the decentralized use cases of the technology. And then you have distributed ledgers, which are centralized, a very compelling long-term investment opportunity. And yeah, both sides are heavily interlinked. Of course, the most well-known crypto asset is Bitcoin. And we consider Bitcoin to be what is in the first generation of crypto assets. It's been around for just under 15 years. And though it is genius in the way that it was constructed, it does have several limitations in the way that it was designed. And as time has gone on, there's been different generations of crypto assets that have emerged, solving many of the initial issues of Bitcoin, but also building on it to apply the technology to different sectors and industries. So yeah, the second generation of crypto assets includes things like Ethereum, which are much more user-friendly. You can use smart contracts to allow for other applications to be built on top of them. And now we have the third generation of crypto assets, which includes things like Solana, which are much more scalable, much more niche in terms of what they can offer. And they allow for additional applications and use cases to be built on top of them. So there's been a bit of an evolution as time has gone on. Many investment opportunities that have arisen from this evolution. And we'll touch on this a bit later, but there are many active crypto funds that are trading these opportunities and entering these opportunities very early on to generate attractive returns. This slide extends that point. So we talked a bit about crypto assets being the economic innovation, more of an inefficient market, very early stage. But there are some very large companies already using this technology, and they've been doing it for a number of years. Of course, recently there's been a lot of news and excitement around a Bitcoin ETF. So BlackRock, Fidelity, Franklin Templeton filing for ETFs. But there are companies such as Amazon, JP Morgan, PayPal. They're actually using blockchain technology to make their processes far more efficient, to save cost, to improve their profits. And to give a few examples, we have Fidelity, which they have their own digital asset arm, focused on mining, custody, execution. Franklin Templeton recently tokenized their money market fund and private equity vehicles. And you also have non-financial companies such as Tata and Warner Music Group that are using blockchain. So Tata with their supply chain, and Warner Music using blockchain for their music accelerator programs. So moving on, there is clearly quite a compelling investment case for crypto and DLT. You have large corporates, banks, governments getting involved, as we just discussed. And they all realize that there is some very attractive long-term upside to this asset class, with disruptive potential virtually across every industry. And if you consider this in the context of the wider macro backdrop, macro is looking quite bleak. Other asset classes aren't really offering the same diversification benefit that they provided in the past. And then you have this new exciting and emerging area in crypto assets that's fast growing and relatively uncorrelated. So provided the risk can be managed properly, it's a great area for investors to consider an allocation to enhance their long-term returns. This is just a visual representation of that. So this slide is showing Sharpe ratios or risk-adjusted returns by asset class over the past 5 to 7 years. You have crypto assets with a Sharpe ratio of above 0.8. Other asset classes have been struggling, especially over the last few years with the changing macro environment. Equities and bonds are fairly close to zero alongside commodities, real estate. Crypto has done very well. And in this environment where cash is yielding 5%, just to give an example, Bitcoin is up over 100% this year. Many smaller crypto assets like Solana are up multiples of that. So extremely attractive returns, even when adjusted for risk. And then if you combine that with the correlation argument, you can see here that correlations of crypto relative to other asset classes in the medium to long term are close to zero. We've done a lot of analysis on this. So beyond correlation analysis, principal component analysis, or microeconomic analysis to understand the key drivers of crypto, which are available on our website. So the correlations are close to zero. That, along with high potential upside, a great tool for investors to use to diversify their portfolios. We have some additional analysis here to illustrate the diversification benefit of adding crypto and DLT to a traditional portfolio. Here we're proxying traditional portfolios using equities, bonds, and alternatives. And we've compared the DLT and crypto market to funds, active funds. I mean, our core thesis is that active crypto funds can outperform in this market. And you can see that here they have higher upside, low volatility, and therefore better Sharpe ratios. But you can see here that in the past 5 years, a traditional portfolio would have only yielded 2.5% per annum with a volatility above 9%. And as such, not a very attractive Sharpe or Sortino ratio. Even adding 5% to DLT and crypto funds would double your annualized performance, only marginally increase your volatility, and therefore substantially improve your Sharpe and Sortino ratios, so doubling both metrics. So yeah, just a way to illustrate the diversification benefit of even a very small allocation to this asset class. So there is a case for an allocation to this asset class, but how do you do it? So here we've outlined various approaches, common approaches to entering both the DLT story as well as the crypto story. In the news, we often hear about venture capital deals or VC funds raising for opportunities in the blockchain space. So these two rows here, the direct VC route, the VC fund route, they are options for investors who want pure equity exposure and sometimes token exposure to the long-term growth story. Some of the challenges here include illiquidity. So it can often take 5 to 10 years to receive your capital back. You often have limited exposure to tokens, and also many of the best deals are quite difficult to access. So unless you have that network and the large amount of capital to participate in these deals, it's very difficult to actually take part. So it's quite pure exposure, but very illiquid. On the flip side, you have blockchain ETFs, which are very liquid, but quite impure in their exposure. So there have been a number of ETFs popping up that offer exposure to companies using blockchain or developing blockchain applications. But unfortunately, they're heavily exposed to tech stocks, and particularly US tech stocks. So very impure in what they can actually offer. So there's a trade-off between the VC route, illiquid, pure, versus blockchain ETFs, which are very liquid, but also very impure. On the crypto side, one way to get exposure is through direct investments. So buying things like Bitcoin and Ethereum on exchange. This can be done. And again, it's a pure play exposure to crypto. However, you're not really getting diversification. You have a concentration to assets that you've conducted your own research on. It requires a lot of time and expertise to pick out the best tokens. And this market changes very quickly. It's very volatile. So the tokens that appear good now may not be the same tokens that will perform the best 6 months from now, or even a few months from now. And there are operational challenges. So when it comes to storing assets, keeping assets secure, transferring assets, ensuring that your assets don't get hacked, that can be quite a stressful experience alongside the volatility. On the passive side, there are Bitcoin funds available and passive indexes that are investable. Often these are quite heavily concentrated in Bitcoin. And for the fees they're charging, they're not really offering any additional downside protection. So, for example, last year and in 2018, during the crypto bear markets, given the volatility and given the pronounced downside, many of these passive indexes were down 80 to 90%, whereas active funds would have been protecting a lot more on the way down by going short and by trading around the volatility. So active funds are quite attractive. There are over 1,000 crypto funds that we have identified at Aaro and that we have in our database. But these funds require a lot of due diligence due to the dispersion of their quality. So they really require a lot of focus in terms of picking out the best funds and knowing where to allocate capital. And then on the topic of active versus passive, so we have a chart here showing the benefit of an active approach. This is still a very inefficient market, strong long-term growth story, but textbook inefficient market, which can be traded on by active fund managers. You can see here that since 2017, active crypto funds, which are proxied by our own indices, they've outperformed the market by 200%. So there's a clear outperformance. That's largely due to downside risk management, so reducing overall volatility, but also being able to make differentiated bets on tokens and protocols beyond just Bitcoin. So often they can outperform on the way up and protect on the way down, which is ideal when it comes to active fund management. You can also see that here. So just some numbers to go along with the chart. Crypto funds, they've produced a return of 1,700% since inception, significantly outperforming the market, which is proxied by the MBIS 100 and Bitcoin. They've done that with 2/3 of the volatility and a little over half the maximum drawdown. So, I mean, this is like the crypto funds are an average of all crypto funds that we've identified at Aaro that are reporting performance, picking out the best funds, rotating between the funds depending on their strategy. So having some form of diversification and some form of fund selection can mean that you can perform even better than these headline metrics. Saying that, there is a lot of dispersion. This plot shows risk versus reward for some crypto funds. You can see here that some funds have performed very well. The returns have been high with low risk, low volatility. So on the top left of this chart, other funds haven't performed very well. Their returns are low, sometimes negative, with very high volatility, and therefore there is value in being able to pick out the best funds, the most repeatable and strongest performing funds in this kind of a market. And then in terms of strategies, so there are different strategies that crypto funds can use in this market. We've developed our own classifications based on hedge fund classifications, but adjusted for crypto. And we categorize funds into 3 different areas. So you have non-directional, trading, and long-term. The non-directional bucket is the most conservative bucket, low risk, low reward, generally aiming for 15 to 20% per annum. And in its own right, it is quite attractive. That's a fairly attractive return, and you can achieve that return because this is such a fast-moving and volatile market. You can have arbitrage approaches, which can be quite traditional in nature. So trading spot against futures, futures against futures, using options, swaps. Just engaging in trades that profit from mispricing. You can also have yield opportunities, which can often be quite crypto native and crypto specific. That can be staking or yield farming in the decentralized finance space, lending, staking. So just eking out some more yield from the market in a different way and in an uncorrelated fashion relative to arbitrage. So yeah, plenty of funds here, plenty of trading approaches. When we first started looking at funds in 2018, there were a few funds doing cross-exchange arbitrage, but now the market is really matured and there are hundreds of funds that are trading using different approaches. So a very interesting area. So that's non-directional. Long-term is the most aggressive part of crypto fund investing. So you can have funds that are taking a very active or venture approach, investing in early stage tokens, in private equity, public market equities, getting more yield from the underlying holdings by staking or engaging in more special situations type of trades. They can also go the passive route, so investing in crypto assets or blockchain funds. although the preference is active. And overall, this bucket is highly directional. So the returns can be very, very high, hundreds, if not thousands of percent in a crypto bull market, but also very volatile. So it has to be balanced against the more conservative approaches. So non-directional is the most conservative, long-term is the most aggressive, and trading is in the middle. So trading is all about risk-adjusted returns. Funds here are much more nimble. They vary their net intra-month. They can be systematic, like trend followers or mean reversion funds. They can be discretionary, so trading on-chain signals or macro signals, technicals to trade the market. Usually focused on top 20 to 50 crypto assets, and they can go long and short, so they can profit on the way up and then also protect on the way down. So all of these approaches are quite attractive in their own right. You can build fund-to-fund strategies in any one area, but when you combine all three of them, it forms quite a balanced story and a very attractive approach, especially when you consider rotations between strategies. So rotating more towards long-term funds in a bull market, and less towards non-directional, rotating more towards non-directional in a bear market, and less towards long-term. So having some kind of a market view, having an asset allocation framework can offer even more alpha in this market. And that's what we like to do at Aaro Capital. We like to rotate between strategies and funds trading these different approaches. And that can lead to even better performance when adjusted for risk. As a fund of funds, there are many advantages. Diversification is one of them. So you can diversify by strategy, style, by fund structure, asset class, and that can help reduce overall risk. You can have a dedicated team that can navigate different market conditions and rotate the portfolio. This is a very fast-moving market. So at Aaro, we've had to build our team to 8, which is the largest of what we know in this area, and that helps us navigate these different opportunities. And then also having that team can offer the expertise of identifying the best managers, monitoring the best fund managers, filtering out those that perhaps are subpar when it comes to operations, and that helps make the most of this opportunity. So when it comes to selecting funds, at Aaro, we've made our own 4-stage selection process, which is based on traditional fund DD processes, but also adapted for crypto. We do this before we engage in portfolio monitoring and portfolio management. The first stage is the data collection stage. We've seen over 1,000 funds. We've built up our database from scratch, and we have all of the data in-house. At this stage, we talk to as many funds as possible. We get materials from as many funds as possible, and we engage in the initial filtering. There's a pretty high drop rate, so you can go from over 1,000 to around 200 fairly quickly, mostly given operational considerations. And then at the filtering stage, we do additional checks on operational setup and investment process, which require a fund to be realistically investable for us. The third stage is the initial due diligence, so investment due diligence, operational due diligence, and also some grading on the funds to confirm their suitability, along with some negotiation. And then finally, an in-depth final investment and operational due diligence, where we do on-site visits. We're going to meet the managers in person. We write up reports, which can be between 20 and 50 pages, on both the investment side and the operational side. And then those reports are presented to the team. So the investment team, the risk divisions, and also our advisory board for full approvals. So it's quite a long process, but it's one that's needed in this asset class. It can take months and sometimes years before we're comfortable enough to allocate to a fund. And as mentioned, operational due diligence is pretty core to selecting crypto funds. It's a core part of our process. We often say that it's equally as important, if not even more important, than investment due diligence. Most funds don't really have long track records in this space, so we can't analyze them in exactly the same way we analyze traditional funds. And some funds are quite small, so there's a lot of dispersion in the quality of not just their returns, but also their setups. Some funds have, really nice custody solutions, tailored for crypto, valuation procedures, independent oversight from directors, and so on. A lot of other funds don't. And it's our job to conduct the research on those funds, do the due diligence, be comfortable enough to allocate once we've done the due diligence, and to monitor those funds so that they remain at the top of their game. So yeah, a very important consideration for us at Aaro, and very much needed when investing in crypto funds. And then that also feeds through to risk management. It's pretty central. So alongside our monthly, quarterly, and annual monitoring, we have risk committee meetings, and we do quant analysis and overlays at our portfolio level in order to target and manage overall risk. Okay, so we've covered quite a bit here today. Covered the investment opportunity, various ways to gain exposure, the benefit of an active approach over a passive approach. Overall, we believe that there are some really sizable investment opportunities in this asset class. It is possible to get attractive risk-adjusted returns, both over the short and the long term. It's a great way to diversify a traditional portfolio. So diversifying away from traditional asset classes that aren't really offering much diversification benefit at the moment. And as such, an allocation to this space through an active approach can offer a great tool for investors who wish to gain exposure. So we believe that an active fund approach makes sense, and the best way to approach this is through a fund of funds approach that is professionally managed, and also with a lot of focus on risk management. So I'll just pause there, and hope it was useful, and happy to answer any questions that you might have.
Well, Ankush, it's me, Stuart McDonald again. We've had a number of questions come through. I mentioned at the beginning that if we didn't have time to address all of the questions from participants in this webinar, that everyone's welcome to get in touch with their Aaro contact in order to delve into their particular questions. And I'll emphasize that, as Ankush said, we have a pretty large investment team. In fact, our expert team, as far as we know, is the largest in the industry for a firm of our type. And we're always happy to spare or to share, rather, an hour, 90 minutes, 30 minutes, whatever is required, if people want to find out more. But perhaps in the time remaining, and we will overrun by a few minutes, I think no one will mind. I can just give you some of the questions that have come through, and maybe you'd like to pick up on whichever one tickles your fancy, Ankush. One of them is, what are your views on regulatory developments in this space? I think we're all aware that things are moving at different paces in different jurisdictions so far as this sort of activity is concerned. Another is, can you explain the fundamental value of crypto? I think a lot of people are interested in that. Two people in effect asked the same question. Another asked, what are the main adoption drivers and use cases that you see? Another question that's quite interesting is, where's the market heading, and what's your outlook for the next year? Someone else asked a pretty similar question, very succinctly, is the crypto winter over? Over to you.
Yep, sure. So I'll kill two birds with one stone. I'll cover the regulation question as well as where the market is heading. I mean, we're thankfully in quite a fortunate position in that we talk to a lot of crypto funds across the world, in different countries, different jurisdictions, and as such, we get quite a good overview of where they are with their own regulators. So in terms of domicile and also what their views are. Generally, we think regulation is very supportive. There is, difference between different regions and the way they're approaching things, but generally, regulators are aiming for a good long-term balance between protecting consumers and innovation. In Europe, there's been a lot more progress recently, with things like MiCA being approved this year and being implemented from next year onwards. Asia and the Middle East have been very active. Some short-term hiccups in the US, but generally we're in a much better place than where we are this time last year. And then, in terms of crypto-specific developments, DeFi, AML, stablecoins, these are still areas of focus for regulators and still generally heading in the right direction. And then generally, in terms of where the market is headed, we track a number of proprietary market indicators that inform our view on where we are, where the market is headed. We actually have a research piece about this on our website that covers our current market view. We believe that the crypto winter is over, and we're in the transition period out of the last crypto bear market into the next crypto bull market. So we're quite optimistic heading into 2024. Our view is mainly backed by our analysis of on-chain fundamentals. So our analysis of the Bitcoin blockchain, the Ethereum blockchain, and the variables that come along the way. But I mean, yeah, blockchain is great for us because we can get a lot of data from the kind of transactions that are taking place on the Bitcoin blockchain, where the flows are going. So which type of holders are holding Bitcoin? Are they large holders, small holders? Have they been holding Bitcoin for 10 years or 1 month? Is the flow of Bitcoin going from exchanges to certain wallets and vice versa? So all of this helps us form a balanced picture of the market, and we can compare it to previous market cycles. So this market cycle relative to the last market cycle, so 2021 bull market, 2017, and even before then. And generally what we're seeing is that the metrics now are showing quite a few trends that are similar to historical transition periods, which makes our view a bit more backed in terms of the way we're thinking about things. We're also seeing a lot more demand from investors. So a lot of investors have been approaching us to become very interested in more directional crypto approaches, which is shaping our view and the way that we're conducting our fund research. So we've been putting a lot of focus on that recently and trying to put our best foot forward when it comes to identifying funds, finding funds that can capture the upside in the next crypto bull run. And then also thinking about the rotation from lower beta plays to more directional or high beta plays as the market progresses. So yeah, overall we're very positive. We think regulation is heading in the right direction. Our indicators are showing trends that are quite conducive to positive market developments. And as a firm, we're positioning ourselves in a way to best profit from those opportunities.
Ankush, thanks for that. It's almost always the way with a session like this that at the last minute, more and more questions are coming in. Pretty wide-ranging set of them as well. More about use cases, more about venture and so forth. Insofar as we don't want to overrun too much, can I only encourage those people who have unanswered questions to get in touch with us, and we'll be very, very happy to address those and any other questions that you may have. I'll remind people that if you do want to find out more, the Aaro website is absolutely full of a range of educational and thought leadership materials. And we really are always happy to share information and to take an educational approach in our conversations with you. So, again, get in touch with your Aaro contact if you want to find out more. There will be more webinars coming up. But in the meantime, we do look forward to speaking to each of you. Developments in this space are nothing short of compelling, absolutely fascinating stuff. And Ankush, thank you for a very clear and compelling depiction of some of the opportunities that are out there and why we take the approach that we do. Thank you very much to everyone. Have a great day.